Okay, hello everybody. Welcome to Korean Atlanta Mentorship here with another Velocity Banking review. And in this video, we're going to show how easy it is to pay off debt. In fact, paying off debt is way too easy. See how I just repeated the title of the video, clickbait. All right, so let's go ahead and get started. So, what's velocity banking? All it is a debt payoff strategy where you throw all of your money into debt with the help of something called a line of credit. So, first step to velocity banking is creating a budget. So, in the last demonstration, we pretended we were doctors, but in this one, we're going to be a little bit more conservative with the income. But this is actually still six figures, but we'll assume that we have a couple, two people in the household that make $6,750 a month. And then we see the expenses here, $6,707 a month with $42 left over in savings. Now, if you take a look at the expense breakdown, you have to list every single debt that you have, right? Because this is a debt payoff strategy. And then you see this red font here. So this is all of your non-debt expenses, food, gas, insurance, all that other good stuff. And so what we're going to do is we're going to change our operating philosophy when it comes to banking, right? So that's what velocity banking is about. So we're going to assume the same income, same expenses, but here's the first step to it, which is not saving money. So you see the savings right here. This is going to go to wablam, zero, right? And if you ask the average person, what's better, paying 40 or having $42 of savings a month or having zero, most people like this number because it's positive, right? Like you're supposed to, I'm sorry, I'm spitting all over. You're supposed to save money, right? That's what a lot of people think. Like, saving money is a responsible thing to do. In fact, I think I read that in the Discover Corporation's website, saving money is the responsible thing to do. Let's see what our Google search tells us. Yeah, look at that. The Google AI is telling us that saving money is responsible. Look at that. Who else is telling us that save SoFi is telling us saving money is important, right? So a lot of websites out there, including the University of California, Berkeley. Heard Berkeley's a dump, but hey, you know what? They might give some mainstream financial advice. All right. So let's go here and we're not going to save money, right? So saving money is kind of like not saving money is kind of like the first step doing velocity banking. And if you want to see what this looks like in real life, and let me do my radio voice here, top of the hour to you. It's we got rain, showers, drizzle coming up in the next morning. Back to you, Bill. I don't even know what type. Sorry about that. So I'm just trying to do a what's it called? Weatherman radio voice or morning zoo, right? All right, so um, what are we talking about? All right, so if I not click here, look at here. This is the zero savings. So the way that we think about the checking account or money in a checking account, it's kind of like a hot potato. As soon as it comes in, we just want to get it out of there as soon as possible. That's really what velocity banking is about, right? And so I practice what I talk about, which is that I don't really save money. And then whenever money comes in, it just goes into debt, into a line of credit. So what we're going to do is we have this cash flow number. And so it looks kind of the same as our savings, but it's not once we start to consolidate some debt. And we're also going to have access to something called a line of credit. So if you don't know what a line of credit is, it's basically a financial tool where you can borrow money, pay it back, and then use it over and over again, right? So um, a credit card is a line of credit because you can swipe, pay it back, and then use it over and over again. In fact, I use credit cards all the time, right? So I have all the lines of credit that you would want: home equity, personal credit card, business credit card. And the great thing about home equity and personal lines of credit is that you can use it to pay anything. Credit cards are a little bit inflexible, but they have their own benefits, advantages that personal and home equity lines don't have. And yes, this is actually my home equity line of credit, $373,500. And so if you take a look here, these are all the lines of credit that I have, including credit cards, right? And so if you scroll down here, I actually have $739,000 in lines of credit. Yes, according to ChatGPT, I'm the top 0.01%. And I actually one day woke up and magically got more credit out of nowhere because I'm going to tell you the secret to getting all these lines of credit, which is banks don't lend money to people who need it. They don't. Lending money to people who need it, according to the bank, is bad. Very, very bad. So you never want to do that, right? You don't lend money to people who need it. And so if you want to know how I got all these lines of credit, I always just went to a bank when I didn't need money. That's simply it. Because the way that the bank thinks of you when you need money is you're like a giant risk. Because think about the time when somebody begged you for money. They said, "Oh, I just need to borrow it. I promise I'll pay you back. I really need the money." And they didn't pay you back. Well, the bank as an institution knows about human behavior. Therefore, they don't lend money to people who need it, right? But for this example, we're just going to assume we have access to a free and clear line of credit. Why? Because this could have just been your lifesaver had you got the money before you needed it, right? In fact, you probably wouldn't be here. That's what I say all the time. Like, yeah, if you if you knew the strategy, you probably wouldn't be here. But a lot of times, people unfortunately learn about these things when they're struggling, which is not a bad thing. I mean, that's normal human behavior, I think. I mean, I wish people were more responsible, but a lot of times they don't try to find out the problems or the solution to their problems until it's just way too late. You know what I'm saying? Right? So this is what we're gonna do. We're gonna move some money or some debt into the line of credit to increase our cash flow. So in this example, we'll assume we have a 7.5%, $200,000 home equity line of credit, and I have 375 or 373 or something. Was it 383? I don't remember. But I know they're building a new retail store right next to my house, which means that the home equity that I can get is probably greater than when I got that one. So home equity based on the value of your home. All right, so let's go ahead and do this. So what we're gonna do is just move some of our debt into the line of credit. And then if you don't know what the cash flow index system is, basically just the formula of the balance divided by the payment gives you a number. And then you want to take these numbers, put them in order, and you take the low ranking ones because they're basically saying, hey, you get a lot of bang for your buck for paying these off. So that's what we're going to do. And how much is this? This is 5, 8, 15, 27, 30. And then what we're going to do is sum this up. And that's $85,000. So what we're going to do is move the $85,000 of credit card debt into the line of credit. And guess what happens? We're at $42. And then all of these payments magically go away. These 5 credit cards. Okay. And so now this is the part that most people just kind of freak out about, which is that you have $42 of savings here, and then you have $2,869 of cash flow. So the final step is that now you have $6,750 of in your personal income that now you're going to dump into your checking account. See, now we're basically treating our income as a hot potato within our checking account. And then we're basically saying, hey, we're not going to save it at all. Right. So what we're going to do is put that paycheck into that line of credit, take our expenses out of it, and then use our cash flow to really drive down our debt. Right. So let's go ahead and do that here. So I'm going to do this. Okay. And then we'll just do this. All right. Minus. So what's our cash flow? It is 2869.97. And then what we're going to do is we're going to take the average daily balance, multiply it by the interest rate, which is 0.075 divided by 12. And then what we're going to do is copy and paste, right? And copy and paste. And then, I'm going to copy and paste. And then this is going to be 33 months. 33 months. This is paid off. All right, so 33 months. And then we paid off 80K. All right, we paid off 80K with these 5 credit cards. I believe it's 80K. No, 85K. My bad. My bad. All right, so let's just do this. 85. Whoopsie. 85K. All right, so we got that. And then we have these amortized loans here. And luckily we got the loan calculator. And actually, someone just messaged me. Give me one moment. Okay, I am back. So let's go ahead and resume our loan payoff. So we have these 2 auto loans, a mortgage, and I think we're assuming this time it's a couple that makes 6,750. You know, 6,000 above 6,000 is like at least 6 figures, right? So 6,750 It's probably like $120,000 a year after tax, I think, if I recall correctly. I might be wrong. I might be wrong. But yeah, so remember, a lot of people used to think, maybe they don't think this nowadays anymore, but if you made six figures of income, that'd be like the sweetest thing on earth. And then now, because of inflation and the cost of goods just rising in general, people don't really believe that. It feels like six figures is like the new minimum wage in a way, which is kind of weird, right? It's like, where are people getting all this money, even though wages haven't gone up? It's like the ultimate mystery. It's like when you see a house in California sold for $1 million. It's like, who's buying these homes? Turns out it's people not from your neighborhood. Okay. All right. So here we got to pay off these three loans, two auto loans and a mortgage. And I'm gonna go ahead and do this, which is we're at month. What month were we at? 33. So 33, 33, 33, 33. Whoopsie. I didn't even, this is wrong. I didn't include a business loan for this example. So I guess I could just delete this. Why did I put business loan? Oh, someone text messaged me. Give me one moment. Okay, sorry, interrupted again. Guess I'm a very popular person, right? So not really. But anyways, all right, so let's go ahead and type in the current month here. And if I type in the current month in this loan calculator, this will tell you, oh, wait, I did do that. 33 months. This will tell you, this will tell you what the current balances of loans are. So we're just assuming that we have two auto loans, exactly the same terms. I don't know how realistic that is, right? I heard there's 0% auto loans. So, maybe you want to hold off on paying the 0% auto loan, right? But as you see right here, you got the cash flow index. Basically, what does this mean? You notice that if you pay the 20 grand, you get $800 in cash flow. But here, 188 grand, it's 843 cash flow. So basically, this low number means you get a lot more bang for your buck for paying these loans off than this sucker right here. So let's go ahead and copy and paste. So this is going to be G2 plus G3. So that's 21 grand. Okay, 21 grand. Yeah. In the what's it called? Here. And we're going to move it into the line of credit, which is 21697.01. And then now what we're going to do is we're going to say put zeros in these auto loans. And then now it's $3,700 of cash flow. All right, so let's go ahead and get started. So this is going to be minus 3706.79. That's our updated cash flow. And then bam, in 39 months. Then the auto loans have been paid off. So that's 85 plus 23 plus 23. So it's 131K. And we are good, right? So now, final thing to pay off is the mortgage. And if you're new to this channel and you want to see me flex financially, I paid off my mortgage in 2 years and 9 months. So if you ever wonder why I joke around so much in this channel, it's because I don't really have to care about a housing payment. I technically have to care because you still have to pay insurance and taxes. And I think my taxes last year was about 4 grand. Insurance was like, how much? Less than 1,000. So, I still have to get some income coming in. But yes, I did pay it off in 2 years and 9 months. Okay. All right. So, we'll now pay off the mortgage. So 200,000, 3%. And I know what some of you are thinking, like, who has a 3% mortgage these days? But a lot of people do. It's just they don't get new 3% mortgages. Okay. So let me just do 39. This is month 39. And then we see here that our current balance of that mortgage is 185,000. Now, if you have a low interest rate mortgage and you're putting in a higher interest rate line of credit, the only, let's say, warning or caveat I say is don't move the whole loan into the line of credit, right? You hear this heard a lot on the internet many times, but I've just done the math with this velocity banking calculator provided by Renatus. And if you don't know, I actually sell their stuff. So you want to pay me and possibly take classes and possibly brainwash yourself over and over again. click the Google form link below. They also provide this calculator if you pay me. So that's what we call independent contracted marketer. I'm kind of a bad marketer, at least for these products, because sometimes I slip in there that I want you to join my cult. Wait, did I say that out loud? Okay, so let's go ahead and then do this. So what we're going to do is put in the numbers here. So 200,000 original balance, current balance is 185,959. So 185,959.04. And then what's the payment amount? It's 843.21. So 843.21. And then what's our current income? So the income here is 6750, 6750. The living expenses is 2200, and then we just put in everything except for the loan we're trying to pay off in the living expenses, and then here in the chunk amount, it's pretty much just a small amount. So let's just do $7,000, and then we see that this gets paid off in 3.6 years. So no need to go to the full term, right? So 11 grand of interest. Even if we use a 30% credit card, look at that, only 3 grand more in interest, right? So when people freak out about like the interest rates, it's like irrelevant to me. I mean, like I actually kind of like using the credit cards for this, because I know if I use a 30%, and I don't think any of my credit cards are actually 30%, but I'm just using the most extreme example. Even if I have a 30% credit card, okay, 30% credit card, sometimes they just randomly raise your limits like they did with this card, right? So this used to be a $10,000 business credit card, and then one day I woke up, which is like 2 days ago, and then they made it to 17,500. So I don't even mind, using a 30% credit card. That's just me. I don't give financial advice, but I'm just saying that moving a loan into a line of credit is completely different effect than doing the chunking, right? So let's say I move this whole loan into a line. You notice I pay more at 7.5% than doing small chunks. So 29 grand right now. But if I do small chunks, 11 grand. Isn't that crazy? And if I move a whole loan into a 30% line of credit, let's take a look at this. It never gets paid off. Okay. So, folks, don't listen to that internet nonsense about how you must always move a loan into a line of credit, right? Don't do it. And if you move it into a 30% line, you're screwed. But if you just do $7,000 chunks into that 30% line, you're fine. You see how that works? All right, so let's go ahead and do this, and we'll say 3.6 years, where it's the final debt payoff, and then this is going to be 0, and then this is going to be 39 divided by 12 plus 7,000, 7.5. No. What am I doing? 3.6. I'm sorry, 3.6. All right, 6.85. So 6.8 years. So 6.85 years. Debt. Oh, see, what am I doing? Debt free. Okay. So 6.85 years, we are debt free. And that's pretty much it. See how easy that was? Or maybe because I just do these all the time and just show. And for me, it's just so easy. Paid in full. So easy. Way too easy. That's the name of the game, right? So, all right. Well, that's it. I don't even know what else to say. So if you're interested in possibly joining a debt-free cult, click the Google form link below. And if you want me to see that you watched to the end of the video, you're looking for the secret code, just type in the title of the thumbnail. Just type in the YouTube comment box. Paying off debt is way too easy. That's how I'll know you watched the end of the video. Okay. All right. That's it for today, folks. Have a great day, and I'll see you all in the next video. It's Creolanta Mentorship.